Hello everyone, welcome to StudyIQ. So we will continue our discussion on economy. We are in the module budget. Okay, so we have completed 5 sessions already. So in the first session we have discussed about what is budget and the structure of budget. I have told you a budget is nothing but the annual financial statement of the government, which is related to the receipts and expenditure, the estimated receipts and expenditure of the forthcoming year. Okay, and under Article 112 it is obligatory, or it is the duty of the president to submit the annual financial statement in both the houses of parliament, and the Article 202 makes it compulsory for states. So it is nothing but annual financial statement of estimated receipts and expenditure of the government in the forthcoming year. So here you can understand there are two parts: receipts and expenditure, right? So this receipts are further divided into, if you see the structure of budget, the capital or revenue receipts and then capital receipts. Expenditure further divided into revenue expenditure and capital expenditure. So I'm not getting into the details of it, as we have already covered this, and this is what our what we have discussed in our first session. And then we have discussed about various budgetary deficits. What is budget deficit we have discussed. Then we have discussed about fiscal deficit. We understood fiscal deficit is nothing but borrowing. Then we have talked about revenue deficit. Revenue deficit is nothing but revenue expenditure minus revenue receipts. There's a worst deficit, because in case if there is a revenue deficit, it is basically revenue expenditures are basically to meet the day-to-day expenditure, okay, the current consumption expenditure of the government. So if there is a deficit, if the revenue receipt is not meeting the expenditure, means you have to sell your assets to meet the expenditure, and that's not a desirable, or in fact it is a worst situation. So revenue deficit should not be there. Okay, so even though fiscal deficit is there, revenue deficit should not be there. So zero revenue deficit and more fiscal deficit, it's not a big problem, because all the deficit are going as capital, asset creation. Okay, so revenue deficit is a problem. If the expenditure is more on capital or creating assets, then it is not a problem. Okay, so and because of that itself, fiscal deficit reduction is easy compared to revenue deficit reduction, because if you need to reduce fiscal deficit, you can do that by reducing the capital expenditure. But revenue deficit, you can't do anything, because revenue expenditure is something which cannot be controlled. It is very difficult. What you can do maximum is increase revenue. Okay, so revenue deficit. And then we have discussed about a concept of effective revenue deficit when we have discussed about revenue deficit. Okay, and because see, some of the revenue, the grants which are given to states, that will be part of revenue expenditure. Okay, but if the state is using those grants to make some assets, then that could be considered as capital expenditure. So it should not be part of revenue, revenue deficit. Okay, so that will be excluded. So effective revenue deficit means revenue deficit minus the grants to states, not all grants to states, those grants to states which are used for creating assets. Okay, then we have talked about primary deficit, which is nothing but the fiscal deficit minus interest payments, because interest payment is done for past borrowings, right? I've told you 1/5 of our budget is done for interest payment. That is around 20% of the budget is for interest payment. The reason also I've told you when we discussed about public debt, the public debt is 49% of GDP, and that's so high. So interest burden is so high. So here primary deficit is because to ensure that intergenerational equity. Primary deficit means fiscal deficit minus that interest. The reason is, the FRBM Act we have discussed. So under FRBM Act, you have certain obligations. So the present government, if they need to meet that obligation, if the interest is coming as a burden to them, they have to reduce the developmental expenditure, and that has to be, bad. So to ensure that intergenerational equity, okay, this is what one of the measure. Okay, so primary deficit. And we have done these discussions in detail, so I'm not getting into the details of it. You can watch all those videos in this Telegram channel. You can join the Telegram channel and you can get in touch with me, this Instagram ID. Okay, so and then we have talked about public expenditure. We have talked about revenue expenditure, capital expenditure, developmental expenditure, non-developmental expenditure, planned expenditure, non-planned expenditure, various committees, Rangarajan committee recommendations, Bimal Jalan committee recommendations, the reason why the abolition of, the distinction between plan and non-plan expenditure, all those things we have done. We have talked about public debt, and I've discussed with you the various components in public debt. I told you what is internal debt, what is external debt, what are the other liabilities, and the percentage, share, everything we have covered. Then in the last session, we have talked about the fiscal reforms, where we have covered Fiscal Responsibility and Budget Management Act, and I've talked about the various targets under the Fiscal Responsibility and Budget Management Act. Okay, so these were the targets. Fiscal deficit has to be, reduced to 3%. It should be less than or equal to 3% of GDP by 2008, and revenue deficit, what is revenue deficit, has to be reduced by 0 by 2009. Monetized deficit, which is nothing but deficit financing, that is printing of currency by RBI or simply borrowing from RBI, should not be there. It means you should not borrow from RBI. That doesn't mean that you should not borrow. You can borrow from other sources through RBI. RBI is actually the debt management agency of the government. Okay, RBI is part of government. We have talked about public debt management agency authority and that proposal also. So this is what we have done so far, and in this session we will be talking about fiscal federalism. Federalism, all those things is part of polity you have studied. Okay, so here we'll be talking about fiscal federalism. Fiscal federalism is nothing but center-state financial relation. Okay, so here not center-state relation completely, I'm taking that part, finance relation. So center-state financial relation. Okay, so here I'll be talking about distribution of taxes between center and states. So the topic for today's discussion is what are the different taxes which is distributed, and how is it distributed between center and states. So 15th Finance Commission. So the Finance Commission is important, that I'll do in the next session. Here I won't be talking about Finance Commission. We'll do that in detail in the next session. There we'll talk about 15th Finance Commission, that is the recent one. Okay, so distribution of taxes between center and states. Okay, so what I'll do is I'll make a column, I'll make a table. With that I can explain all the taxes which is coming between center and state. So rather than discussing various articles separately, it will help you to connect it. Okay, so I'll make a column. So first I'll go for central taxes. Central taxes, one column I made. Shareable taxes. Okay, now actually after 80th constitutional amendment, these two have merged into central pool of shareable taxes. So these two have merged into central pool of shareable taxes, and 14th Finance Commission recommended that 42% of this will be given to states. So central pool of shareable tax. So what is the share of states? 42% of it should be given to the states. And how is it to states are based on different criteria, and that we'll be discussing in the next session when we discuss about Finance Commission. So there are different criteria upon which states will get the share. Okay, so 42% of the central pool of shareable taxes has to be given to the the states, and the 15th Finance Commission, by that time Jammu Kashmir was not part of this, so it was reduced marginally to 41%. So as per 15th Finance Commission, the central pool of shareable taxes, from that 41% has to be given to the states. We'll discuss that in detail. Now we will just make this column like this. Then we have states taxes. Okay, states taxes. Then we have Article 269. So here Article 269, the taxes which are imposed and collected by center and appropriated by state. Okay, so imposed and collected by center and appropriated by states. Why it is imposed and collected by center and appropriated by states? It is actually done for administrative convenience. So when we talk about the taxes which is coming under this, you will understand, okay, like taxes on railway fares and freights, etc. So states, it will be difficult, okay. So we'll come to that. We'll discuss the components so that you'll understand easily. So it is basically done for administrative convenience. So which article here? Article 269. Article 269. Under Article 269, this category is coming, okay. Then another category is here imposed and collected by center and appropriated by states. So next is imposed by center, collected and appropriated by states, okay. So imposed by center, collected and appropriated by states. Now what do you think will be the reason for this? This is Article 268, okay. This is Article 268. So 269 is for administrative convenience and 269 for administrative convenience, you can see that, and 268 is basically for ensuring uniformity, okay. So if you want, you can write it somewhere here. This is for administrative convenience. This is basically to ensure the uniformity in taxes. The third, so here the first one, imposed and collected by center and appropriated by states. Then second one, imposed by center, collected and appropriated by state, okay. Third one, imposed by center, collected and appropriated by center and states together. Only one tax will come there, that is service tax. Will come to that. So that is Article 268A. 268A, imposed by center, collected and appropriated by center and states. So only one tax here that I can fill it here right away, that is service tax, okay. So only one tax here. Now the taxes will come here. There are so here this also we will fill now directly, because there are only two taxes here. The first one here, the first one is actually stamp duty. Which one? I'm talking about Article 268, stamp duty. Not all stamp duties except on agricultural land and financial documents. Why? Because stamp duty on agricultural land will come under state taxes, so that you can write there. Then stamp duty on financial documents will come under central taxes. So here, where I'm talking about the taxes which is imposed by center and collected and appropriated by states, the first one is stamp duty except agricultural land and the financial documents. So stamp duty except on financial document. I'm not writing completely, you write it completely, okay. Financial document and agricultural land. So that is the first one. The second one is excise duties on medical and toilet preparations containing alcohol. Okay, so excise duties on medical and toilet preparations containing alcohol will come here. What about generally excise duty? That will come under shareable taxes. So if it is excise duty on medicine, where it will come? It will come here only. But if that medicine contain alcohol, then it will come under Article 268. Okay, similarly, excise duty on toilet items, that will come under shareable taxes, normal. But if it contain alcohol, then it will come here. So I hope you understood this section. 268A we have done only service tax. 268 we have done two types of taxes, that is stamp duty, which is except financial documents and agricultural land. Then excise duties on medical and toilet items except which is containing alcohol. These two will come here. So only two here. Okay, so two here. Now here we will see shareable taxes. Here income tax. Okay, then union excise duties. Union excise duties. Now this is part of central pool of shareable taxes. So it's not, that division is not important. So here also two taxes. What about central taxes? Central taxes, you have corporate income tax, that MAT, minimum alternate tax, dividend distribution tax, stamp duty on financial documents, which I have told you is not part of 268 here. right? I've told you it will come here. So stamp duty, this corporate income tax, MAT, DDT, all this taxation module we have done. You can get that videos, okay? You watch that videos, please. So stamp duty on financial documents, then custom duty, gift tax, all these will come here. Gift tax, wealth tax. Now this wealth tax is not there, instead surcharge is there, that things we have discussed. Then capital gains tax, etc. All these will come here, okay? Now let's fill up this states taxes. States taxes. More are there, so I'll write it separately. This third one, states taxes, I'll write separately. You can fill that in the table itself. States taxes, sales tax or trade tax, okay? Sales tax, trade tax. As I've told you, stamp duty on agricultural land. So stamp duty except financial document and agricultural land will come under 268. Stamp duty on financial document will go to central part, and stamp duty on agricultural land will come under state taxes, okay? So stamp duty. Now it is not that difficult to remember. You just need to know that last one, that here we have discussed about only one tax, that is service tax. Here we have discussed about two taxes, and these are easy to remember. Now this is mix, right? Then if you know this, these are all this fourth one also few items only, then everything else mostly will come under state taxes. It is not that difficult to remember. But if you know this table like this, rather than studying article 268, 268A, 269, these are the items, state taxes, rather than studying in that way, if you go with this, okay, there is no need to read anything else. So stamp duty on agriculture land, excise duty on liquor and narcotics, excise duty on liquor and narcotics, okay? Inland waterways, land revenue, agriculture income tax, octroi, okay? Octroi, that is basically entry or toll tax, okay? This is actually by municipality, or house property tax, taxes on vehicles. These two are municipality, okay? Taxes on vehicles, taxes on animals, taxes on land and buildings. Basically property, taxes on land and buildings, taxes on trade, profession, employment, taxes on trade, profession, employment, taxes on luxuries and gambling, taxes on luxuries and gambling, taxes or duties on electricity. So all these will come here, okay? Now what about this one, article 269? So 269, what is the logic? It is imposed by the center, imposed and collected by the center and appropriated by states. I've told you it is for administrative convenience, so mostly railway fares and flights, right? So first one, here I'll write taxes on railway fares and flights, taxes on railway fares, and see, by seeing this itself you will understand it cannot be collected by states, so it will never come here. It has to be collected by center and it will be given to the states, okay? So taxes on railway fares and flights, then terminal taxes on goods and passengers carried by rail, air, sea, etc. Interstate tax, like central sales tax is there, okay? And then IGST after GST. See, I'll write it separately. I don't have space here. So 269. So 2 we have already written. I'll write. See, what is this CST, central sales tax? Why it is imposed? See, for example, Tamil Nadu is producing something, okay? So Tamil Nadu is producing something, so excise will go to center. So Tamil Nadu is not getting anything upon production. Then states will get from what? Selling, sales tax. But suppose Tamil Nadu produce this excise upon the center, and if the selling is happening at Kerala, then the sales tax is for Kerala. So Tamil Nadu is actually not getting anything despite the fact that Tamil Nadu is producing this. I hope you understood, right? So excise go for the center, and the sales tax for that particular item will go to the Kerala state because the sale is actually happen over there. So what will get for the producing state? That is the reason why there is a central sales tax imposed by the center. Okay, and that is why I've told you, for administrative convenience it is imposed by center, collected by center, and will give it to Tamil Nadu, so that the producer will not be losing that money. Okay, at least something have to be for the Tamil Nadu state also, because Tamil Nadu is actually the producer, right? So central sales tax, now this IGST, integrated GST, which also serves the same purpose. So apart from that, taxes on forwards, futures, trading on commodities, taxes, this will also be part of 269. Apart from that too, okay, taxes on forwards, futures, on commodities. This I'll discuss in detail in capital market. Okay, the module is coming. That module is coming. I've not yet taken that. I'll discuss what is forwards, what are futures, what is put auction, what is call option. You might have a lot of doubt. Derivative trading, everything we'll cover in detail. So just wait for that. Then taxes on sale of newspapers and advertisements therein. See, I've told you here, based on the recommendations of 10th Finance Commission, these two have merged to Central Pool of Shareable Taxes. Okay, so based on the recommendation of 10th Finance Commission, those two have actually merged to, Central Pool of Shareable Taxes. Central Pool of Shareable Taxes. And 14th Finance Commission actually recommended 42% should be given for the states from this pool, and 15th Finance Commission, the recent one, recommended 41%. This I'll discuss in detail in the next session, so I'm not getting into that now. Okay, now you see the only revenue collected from cess and surcharge exclusively to center. Otherwise, you can see here, let's mark it like this. This is 1, 2, 3, 4, 5, 6. Okay, so in this 268A only one will come, no need to have any confusion. 268, these two will come. Okay, stamp duty except on financial document and agricultural land, excise duty on medical and toilet preparation containing alcohol. If it is not containing alcohol, it will be part of excise duty. So 268 is done, so which is imposed by center, collected and appropriated by states. 268A imposed by center, okay, collected and appropriated by center and state together. So here 269, railway freights, etc., and we have seen newspaper, forwards, futures, all those will come here. Okay, then states taxes, we have seen that is a maximum. Okay, we have seen different types of taxes here too, but since 10th Finance Commission onwards, this actually merged to Central Pool of Shareable Taxes. So I hope this is clear. You don't want to have any doubts in this now. So it's actually a very complex topic. Now, if you can study in this way, if you can remember this logic that 268A is actually only one service tax, 268 only two, these are the two items, 269 imposed and collected by center for administrative convenience given to states. So by seeing the taxes itself, you can understand, is it 269? Then you can see here, this will be now shared together, this will be together like this. Okay, so you can see here, now this tax is the first one and second one, Central Pool of Shareable Taxes, so that has to be given to states. Okay, then this is exclusively states tax. Then here also 269 appropriated by states, 268 appropriated by states, so 268A appropriated by center and states. So now all taxes are shareable with the states except what? The cess and surcharge. Okay, so now only revenue collected from surcharge and cess exclusively to center. These two are surcharge instead of wealth tax. Okay, that I've told you. It is actually a presumptive tax. Okay, so everything else now is shareable with the state. I hope you understood. If you have any doubts still, you can get in touch with me here. This is my Instagram ID, and you can join the Telegram channel. You will get all my videos over there so that you can complete your economy. There is no need to read any